1.18. You are provided with information relating to Select Limited for the financial year ending 28 February 2025. Required. 1.18.1. Calculate the following amounts for the statement of cash flows, change in loan and income tax paid. 1.18.2. Complete the extract from the statement of cash flows for the net change in cash and cash equivalents. 1.18.3. Calculate the following financial indicators on 28 February 2025. Your quick ratio, debt equity ratio, percentage return on average equity, and your net asset value per share. 1.18.4. The liquidity of the company has improved. Quote 3 financial indicators to support this statement. 1.18.5. Dividend policy. Provide figures to show the change in the dividend payment policy. Explain why the directors decided to change the policy. 1.18.6. James is the Chief Executive Officer. His shareholding is as follows. Number of shares 420,000. Date purchase 10 January 2024. Percentage shareholding 46.7%. A. Calculate James's percentage holding on 1 October 2024 after the repurchase of shares. B. Explain how James has gained an advantage from the decision to buy back the shares. And C. The independent auditor discovered that James took the decision to buy back the shares without informing or consulting the board. Why must the independent auditor be concerned regarding this? 1.18.7. The statement of cash flows shows that fixed assets were purchased for 4.5 million rand. Name 2 main sources of funds for these fixed assets with figures more than R1 million each. For each source, indicate whether it was a good or bad decision. Support your answer by quoting relevant financial indicators or figures. Information A. Share capital and dividends. On 1 March 2024, 900,000 shares had already been issued. On 1 October 2024, 75,000 shares were bought back at R10.70 per share. On 1 January 2025, 125,000 ordinary shares were issued at R10.80 per share. The 2025 statement of cash flow shows dividends paid of 434,250 rand. B. Extract from the statement of comprehensive income on 28 February 2025. Revenue 5,220,000 rand. Cost of sales 3,600,000. Operating profit 1,295,000. Income tax 190,500. Net profit after tax 444,500. C. Extract from the statement of financial position on 28 February. They give you the 2024 and 2025 year, the fixed asset carrying amount, fixed deposit from ABSA, the current assets which comprises of inventory, trade and other debtors, and cash equivalents. For inventory, it's only the trading inventory given. Then the equity, they give us the ordinary share capital and retained earnings for 2024. 2025 we need to calculate. Low net bank, and for current liabilities they give us trade and other creditors, shareholders for dividends, SARS income tax, and bank overdraft. D. The following financial indicators were calculated on 28 February. Also again for 2024 and 2025 they give you the current ratio, the quick ratio only for 2024, the inventory turnover rate, the debtors collection period, the creditors payment period, the solvency ratio, debt equity ratio only for 2024, return on capital employed, return on owner's equity only for 2024, earnings per share, dividends per share, net asset value per share only for 2024, market price, and interest rates on loan. 1.18.1. Calculate the following amounts for the statement of cash flows, change in loan. If we go back to information C, our loan net bank, in 2024 we had 4.5 million, and now in 2025 our loan is 8 million. So there's an increase in our loan of 3.5 million rand. For income tax paid, we go to information C. For SARS income tax, our opening balance is 23,400. If we go back to the income statements from extract B, our income tax in the income statement is 190,500 Rand. And our closing balance, again from information C, we minus 6,200 Rand. And that then gives us an amount of 207,700 Rand that we physically paid towards income tax. 1.18.2, complete the extract from the statement of cash flows for the net change in cash and cash equivalents. So we start with our cash and cash equivalents at the beginning of the year. And if we go to information C, in 2024 it was 7,500, and in 2025 it was 205,000. So our cash and cash equivalents at the beginning of the year, we have a positive balance of 7,300, as well as a bank overdraft of 610,500. So to calculate the cash and cash equivalents at the beginning of the year, it will be 7,500 minus 610,500, and that will then give you a bracketed amount of 603,000. Our cash and cash equivalents at the end of the year was 205,000. So our net change in cash and cash equivalents will then be 808,000. 1.18.3, calculate the following financial indicators on 28 February 2025. The quick ratio or asset test ratio is your current assets minus your inventory to your current liabilities. So if we go back to 2025's figures, our current assets is 1,015,000 minus the inventory of 564,000 to your current liabilities of 635,200, and then it simplifies to 0.721. The debt equity ratio is your non-current liabilities to your shareholders' equity. So for 2025, our non-current liabilities is 8 million, and our shareholders' equity is 10,050,750. And if we simplify that, it's 0.821. Percentage return on average equity, or ROE in brackets, that will be your net profit after tax divided by your average shareholders' equity times 100/1. So our net profit after tax, if we go to extract B, is 444,500 Rand, and our average shareholders' equity will be half of 2024 plus 2025. So it's half of 9,540,000 plus 10,050,750. Then if we times that amount by 100/1, we get 4.54%. Net asset value per share in NAV. Okay, so to calculate the NAV, it will be your shareholders' equity divided by the number of issued shares. Now if we go back to information A, we started with 900,000 shares, then we bought back 75,000 shares, which we'll minus, and then we issued an additional 125,000, which we'll add. And our shareholders' equity for 2025 is 10,050,750. So it's going to be the 10,050,750 divided by 950,000 shares times 100/1 to give you 1,058 cents per share. 1.18.4, the liquidity of the company has improved. Quote 3 financial indicators to support this statement. Okay, so the 3 indicators that I would quote is the current ratio, the quick ratio, and the debtors collection period. The current ratio improved from 0.321 to 1.621. The quick ratio improved from 0.1.1 till 0.721. And the debtors collection period improved from 43 days to 36 days. 1.18.5, provide figures to show the change of the dividend payment policy. Okay, so we will comment. In 2024, the dividend per share was 35 cents versus the earnings per share of 58 cents, which means that 23 cents per share were withheld as retained income for growth. In 2025, the dividend per share was 55 cents and the EPS was 51 cents, which means that retained income from the previous year was used to pay dividends. This will have a negative effect on future expansion and growth. In 2024, the payout ratio is 60%, and in 2025, the payout ratio is 108%. Explain why the directors decided to change the policy. Shareholders wanting an income from dividends will be satisfied and will be willing to pay more for the shares. The dividend on NAV is now 5.2% compared to the 3.3% from the previous year. 1.18.6. Calculate James's percentage shareholding on 1 October 2024 after the repurchase of shares. So we're going to start with his number of shares, which is 420,000, and then we divide by the amount of shares we have in the beginning of the year is 900,000 minus the 75,000 shares that we bought back times 100/1. That then gives us 420,000 shares divided by 825,000 shares times 100/1, and that gives us 50.9%. Explain how James has gained an advantage from the decision to buy back the shares. James now owns more than 50% of the issued shares. He now has the managing share and can make all the decisions. The independent auditor discovered that James took the decision to buy back the shares without informing of consulting the board. Why must the independent auditor be concerned regarding this? Now remember, it is unethical towards the other shareholders. It handed James the managing share, and it is a requirement of the Companies Act that the repurchase of shares from the director must be approved by the shareholders. (1.18.7). The statement of cash flows shows that fixed assets have been purchased for 4.5 million rand. Main sources of funding, good bad decision, explanation with financial indicators and figures. So we must name two main sources of funds for these fixed assets with figures, more than R1 million each, and for each source indicate whether it was a good or bad decision. Support your answer by quoting relevant financial indicators and figures. The first source, I would use the loan that increased from 4.5 million rand to 8 million rand. This would be a bad decision, and my reason would be your return on average capital employed, that is the financial indicator that I will use, declined from 9.5% to 8.2%, which is negatively geared against interest rates on loans of 12%. And for source 2, I would use the information of the additional shares that was issued. Now 125,000 shares was issued at R10.80 per share to give you 1,350,000 rand. This is a good decision, and to help me with my answer, I would use two indicators. the net asset value per share, and the return on owner's equity per share. Okay, so although the NAV declined slightly from 106 cents to 105 cents, and the return on equity from 6.2% to 4.54%, there has still been a huge saving on interest expense.